This month, we were treated to many important and new economic data releases. A perfect moment thus for an update on the current state of the economy. And there are a few things that do stand out. For instance, that the economy appears to be even more resilient to the pandemic than initially thought. But the latest figures also show that inflation is higher and more persistent than initially expected. And labor markets are reaching record levels of tightness both in the US and in Europe. We are apparently moving gradually towards a late cycle scenario. And all of this against the backdrop of rising geopolitical tensions that are driving up energy prices and thus in turn are supporting inflation. The fog surrounding the impact of the Omicron variant is gradually lifting, and it seems that we have escaped the worst-case scenarios. Although Omicron has led to unprecedented infection waves throughout Europe and North America, it has not, and certainly not in Europe, led to a new and extreme overloading of the healthcare systems. And so, a feared new general lockdown has been avoided. Nevertheless, the Omicron wave will have an economic impact. Temporary loss of labor due to illness or quarantine and declining consumer confidence will depress growth for the coming quarter. But one lesson is already clear. The economy is becoming increasingly resilient to the pandemic shocks. The latest growth figures for the fourth quarter of 2021 also show this. These figures were in generally better than expected, and especially in the US, where growth in the fourth quarter ended sharply higher, pushing up the final annual growth rate for 2021 to 5.7%. A false note in this story, however, is that the recent growth was mainly driven by business inventory rebuilding rather than by strong increase in consumption. We continue to expect solid growth in the US for 2022, but significantly lower than record growth of 2021. And also Europe managed to avoid a new winter recession despite the Delta and the Omicron variants. At least that is what the first data seem to indicate. With growth of around 0.3% quarter on quarter, the Eurozone also closed the GDP gap and reached the pre-crisis level again in this fourth quarter of 2021. And this marks the end of the economic recovery phase and the beginning of the expansion phase. We expect economic growth in Europe to continue and, after a weak first quarter, to strengthen during the year. However, given the tightness of the labor markets and high inflation, this growth will gradually evolve into late cycle phase. The growth peak appears to be behind us, and we expect growth to gradually converge back to its long-term trend with standard growth factors now, such as demographics, productivity, capital intensity, regaining importance relative to the current catching-up process and the policy support. Yet, important growth differences across countries remain, and those differences have to do with economic structure. For example, the German economy contracted significantly in the fourth quarter, plagued by labor shortages and persistent problems in industrial supply chains. And pandemic-related mobility restrictions also weighed on consumption. Other countries, such as Belgium or France, experienced higher than expected growth on the contrary. Now, turning to inflation, it seems that the latest figures confirmed what was feared. Expected turnaround of European inflation figures was much less than anticipated. Higher than expected energy prices largely neutralized a number of downward technical factors, causing inflation in the Eurozone to stabilize around 5%, 5.1% to be precise. In a number of countries, inflationary pressures even increased. For instance, in Belgium, with inflation now reaching 8.5%. Moreover, the current geopolitical tensions make inflation outlook very uncertain. High energy prices will keep inflation at a high level for some time, and only towards the second half of the year do we expect inflation to slow down. And it is becoming increasingly clear that the ECB is in danger of falling firmly behind the curve, especially now that the ECB is leaving interest rates unchanged despite more persistent inflation. But also within the ECB, inflation fears and pressures are rising, as shown by its latest communications. We expect the ECB, under pressure from high and more persistent inflation, to raise its interest rates for the first time later this year. The Fed, on the other hand, is meanwhile preparing for a much firmer tightening cycle. The kickoff of that tightening cycle will probably start as early as March. Financial markets are now assuming 5 possible rate hikes by 25 basis points each, and the outlook for quantitative tightening to start from the summer is taking more and more shape. With that tightening, the global financial cycle also appears to be turning. Long-term interest rates are gradually rising, and we expect that trend to continue. In time, this will also become a point of attention for real estate markets. Despite the crisis, real estate prices are overall strongly increasing. Annual growth rates of more than 10%, and in some cases even 20%, are the norm rather than the exception. And such price increases are a clear signal of overheating and may lead to increasing overvaluation, especially in an environment of rising interest rates. We do not expect a crash in the real estate markets, but rather a cooling down. Close monitoring seems therefore also appropriate. In short, good news from the real economy, but less good news from the inflation front. The economy is digesting the pandemic better and better, and after a record year in 2021, economic growth seems to continue in 2022. But inflation is stronger and more persistent than expected, while central banks are heading for a loss of credibility if inflation wave is not quickly reversed. The ECB seems behind the curve, while the Fed is now moving quickly. Whether ultimately it will be too little too late or not is the question to be answered in the course of this year. But it is clear that financial and real estate markets will face a volatile period. And then there is the elephant in the room. Geopolitical tensions remain an important short-term downside risk. A normal year does not seem to be in the cards for 2022 either.